Hello, everybody. Welcome to National Coffee Day at the Enlightened Investor show here.
For the tea drinker.
For the tea, yeah, I'm mainly a tea drinker.
Espresso.
And Mr. Mike there is our coffee drinker. So we've got a great show here for you today, really talking about mining the gap. You know, obviously there's a lot you can do to improve your rate of return, and sometimes it's like not doing anything, but you've got your life, your money, and where we come in with our education is how real financial advice, how you can improve your rates of return by simply, not trading, diversification, dollar cost averaging. There's a lot of simple things you can do that don't show up. Market timing.
No panicking.
Yeah, no panicking. Doesn't show up on CNBC, does it, Mike?
Squawk box. Yeah, quit following a squawk box.
Don't follow squawk box. Follow us.
Right. Exactly.
So, anyways, what we were talking about here, the thing that is really cumbersome for our retail investors is that the investment returns of the world today are much larger than the returns for the average investor. And we call that, Mike, what do we call that?
The investment gap.
The investment gap. And it's behavioral, it's all kinds of things. And let's talk about that today. And we're going to get right into this by looking at what the data is showing. And we're going to use the help of Morningstar. They do an annual study called Mind the Gap, which looks at 10-year time horizons to take a look at investor returns versus investment returns. And you can see here, Mike, we're going to show a slide here that looks at the gap is how large over this 10-year period?
1.68% overall.
That's substantial. And can you kind of break down this?
Yeah, we can kind of walk through
what
we're looking at here. So what they do is they're breaking it down in categories of different funds, and they start out with an allocation fund, which I assume they're looking at all the different funds that basically are made up to look like a portfolio.
Target retirement funds,
yeah,
even
exactly.
things like that. Mm-hmm.
Yeah. Alternatives, that is REITs, reinsurance, all different kinds of different oddities. It seems to be that's the most extreme gap at 4%, and my assumption is that's really a lot of behavior that's bad with people chasing returns, trying to catch what's hot and cold. International equities, 1.39. Municipal bonds, which are tax-free bonds, that's huge. It's still over 1%, and that's probably about all they yield right now. Sectors, again, that's people chasing again. Probably it's almost 4%.
Yeah, energy, healthcare. They think that's the next big thing.
Where you at? Chasing.
Actually, even Kathy Woods, really, Mike, a little bit there with just investment, long-term technology,
right. Yeah,
sectorial.
Final taxable bonds, again 1%, and that's probably about all they yield right now. So you're basically wiping out your yield. And then overall, just U.S. equities, again, it's like 1.17, and that's pretty huge compared to what you should be trying to earn with just a simple index fund or a simple index ETF.
So you're looking at, Mike, negative 1.68. And,
right.
Whenever I think about numbers like that, it might not seem like a very big deal, like a big deal. But don't forget what Albert Einstein...
Compounding.
Well, exactly. Right. Albert Einstein, you're a quote guy. He said, the most powerful thing in the universe is exponential compounding. So if you take that over a period of time,
right.
The next thing we want to share with you here, folks, is that this behavioral gap really adds up. And, over your lifetime as an investor, you could be looking at hundreds of thousands of dollars that you're missing out on simply because of some issues with behavior.
Timing and et cetera.
You want to take a look at maybe the second,
this next
second
one we
slide
look
for him?
at. I just kind of ran some numbers here. It took $1 million. If you first 10 years, that gap of 1.68% cost you $181,286, so roughly $200,000. You move that out 20 years, it's almost $400,000. And then you move it out 30 years, and it's $650,000 roughly.
Yep.
I mean, it's tremendously huge.
And with people living...
It can be avoided, simply.
Yeah, it can be avoided. People are living longer. Yeah, avoid the noise. And, what we're trying to do here is help people with, their life plans. And, a lot of people don't know that they're going to live to 90, Mike. And so if you're looking at these large time horizons of 30 years...
think about young people. You're talking 60 years.
Yeah.
I mean, that number, you keep doing the compounding on that number, and it becomes huge. You're over probably a couple $1 million, I'd guess, right?
Yep.
2 or 3 million.
Yep. And what's funny is, we looked at that as alternative funds, Mike, and a lot of people think like, hey, I can do better. I can do better than, investing with broad diversification, broad index funds. And I'm going to listen to the new hot thing out there and
Meet Kevin.
you meet Kevin.
We'll talk about him one day too. I think he targets the millennials more, but
yeah, he does. Yeah. And meme stocks and, momentum. Also, that the whole issue on innovation, this whole Kathy Wood innovation. I mean, I actually kind of like some of the things she does. I think that her idea that, hey, the innovation is multiplicative. There's potential for a long run.
Multiplicative. Love that.
I know. But what
Can we talk about Kathy Woods?
Let's talk
that's
about
where
Kathy
we're headed.
Woods.
All right, let's talk about
Exactly.
Kathy Woods then, all right?
So let's talk. Go ahead.
All right, let's look at the Wall Street Journal data. And I grabbed this from a while back. This was on a May 10th article from the Wall Street Journal. And they looked at your Kathy Woods innovative fund. And the returns have been phenomenal since they started. So she started in October 14, so 6.5 years. Compounded return was 34%. So if you had $1 million in that, you almost have $7 million now, right? Wow. Knocked out of the park. Fantastic.
Yeah,
but what the Wall Street Journal looked at then was, well, the problem is that the money didn't flow into this fund. And I think at the time she had $1 billion, but then the money flowed when the returns were like this. But then the money flowed in afterwards, and the average investor, the weighted dollar returns, like the 30+ billion that went after the returns were good, only made 5%.
Yep.
So if you
Which
bought
is
a simple index fund, you would have made 14%. He did nothing. And what's more interesting is if you look at this ARC fund, you roll back the curtain and look at it. It's very concentrated. It's in all your innovative things you were talking about. Tesla's the biggest holding.
10%.
And it's been on fire. It's done 47%. You could have bought Tesla, made $14 million.
That's right.
But, I guess it's okay if you want to play with a little bit of your money in something like this. But it's really imprudent to take this approach with your whole money and how your concept of your plan and your portfolio.
You want to stay as an investor.
Yeah.
And I think the gap on here, folks. A quick look. The gap is not 1.68%. The gap between the 1.39 and the 6.8 is like 80%.
It's huge.
And I think this is like it's stupid money. It's Americans. They flow into Kathy Woods funds when the fund is going up. They've missed already the low, and then they sell when the Kathy Woods
fear of missing out.
Fear of missing out.
Yeah.
So that's a big issue there.
The media is going to push whatever's hot because the simple build an index portfolio and enjoy your life doesn't sell, doesn't get clicks, doesn't get subscriptions. So you got to always have these new ideas.
Mike, and I really like what you said there. Like, you can do this with a fraction of, take a small,
if you must.
If you must, right?
Yeah.
If you must,
some people like get the entertainment value out of it.
Yeah. If you want to gamble,
what did casino?
What did some of the great economists say? Like, if you want to go gamble, go to the casino, right? But this is your investing, and stick with what works.
I think we want to end. I want to provide some more data, and we'll put that up there. This is from Michael Kitces. He's a well-known leading financial planning expert. Tax expert across the country, and I like this piece he put together. He basically went through numerous areas where you can add value to your portfolio long term, and he put the estimates in there. And his estimate on the behavior gap was right at about 1.5%. And I will mention this because we were talking about this pre-show. We looked down through there because we just had this topic recently.
Yeah.
I don't know why he has this, because I know he has articles out there that show you that the advantage of Social Security is much more than $10,000 if you plan it correctly. So I'd have to I may reach out to Michael because he's part of my group through the back office and see.
Cool.
If this is a typo or what happened.
Or why did he have it such a low
Other
number?
than that, I think this is all spot on and very good. And I mentioned at the very beginning, you saw that chart of the behavior gap, and this was all kind of made more popular by a friend of mine, Carl Richards. He actually wrote a book. His first book was The Behavior Gap, and his first drawing was that drawing. And if you go to his website now, he's in the New York Times. He writes articles for the New York Times. He's done numerous charts now, and it's all about our behavior with money. And the cool thing about his drawings is you don't have to read anything to get the message. Mm-hmm. So it's worth, if you enjoy stuff like that. Yeah,
right
really
back here, folks.
you can take a look at them. They're pretty good.
Yeah. We did a wide angle shot today so we
Right,
could get these in.
the new iPhone. What do you think?
Oh man, you
Yeah.
did it yesterday,
And what a
right?
deal. I mean, you take it in there, and I think it's like $1,100 phone. And then they tell me, we'll give you $800 off your 10.
Yeah.
And but you got to pay $500 a day for your new case and your phone, but we're going to give you a $35 credit for the next
yeah.
2 years. So I'm guessing I walked out for a couple $100, and we got our new camera for the
Hey, they did some
YouTube.
marketing deal on you there,
Meet
Mike.
Kevin, he's coming. We're coming, Kevin. 2 million viewers.
Well, I really love this this financial planning guide and what
That
the
was a
value
good
is.
topic today, yeah.
Yeah, I mean, I think that from the behavioral benefits you get from having a financial advisor, I think there's some great stuff to learn in this document. So
Yeah, that was good.
yeah, good stuff. So, folks, I hope you enjoyed today's show. We really love to get some of this data, this real life look at what's going on in the investing world, and sometimes we find that these the simple stuff works, right? Like sticking with a plan that's been pre-made up with a financial advisor ends up to have great outcomes. So
Well, the key is focusing on what you can control.
Focus on what you can
There's so
control.
much of the industry just throws all this on the wall and sees what's stick, and it always changes. And
We've
quite
got-
in fact, you look at it, there's a lot of things you can do that you can control that can truly add value, that can be measured.
Yep.
Yeah.
So if you like this programming, we're doing
Like
this.
us.
Yeah, give us a like up.
Like, thumbs up, share it with your friends.
Yep, and we're going to be putting some of this documentation in our website, enlighteninvestor.com, as well as in the description below. So thanks so much for being here, folks. We'll see you in the next time.